Well, Kevin Flanagan is the fixed income strategist for Morgan Stanley Smith Barney, and he says the bond market is looking for any indications of an exit strategy from the Federal Reserve. Kevin joins us now from Purchase, New York. Kevin, great to see you.
Thank you very much.
So it sounds like the takeaway, the early expectation is that we probably won't hear much, at least today, on exit strategy. What do you think?
Yeah, I would tend to agree with that. You know, much like we just heard Secretary Geithner, I don't think anyone's expecting to have the Fed talk about raising rates. So it's all about any changes or modifications to their asset purchase program like they did 6 weeks ago for Treasuries. Are they going to make any changes with mortgage backs or agencies?
Talk about how the bond market is setting up today ahead of the Fed, though. It looks like some selling.
Well, yeah, it was interesting. You mentioned it a little while ago in terms of the 5-year auction. It wasn't the greatest of receptions, I think, so the market is sort of feeling some supply indigestion and now waiting to see what the Fed has to offer.
But is it safe to say, though, that since, or if there was any serious concern about the Fed today, we wouldn't have seen such, well, we had stronger demand, I guess you could characterize, for the 2-year auction yesterday, and then today's 5-year was decent?
Yeah, I think, you know, if people were concerned that the Fed would drag their heels or maybe raise rates quicker than expected, that maybe you'd get more of a response. But we seem to be in a Fed holding pattern right now, and it's rare that we have these kinds of meetings and no one's expecting any fireworks. What, though, if the Fed tinkers with its line, "We'll use all available tools"? Would you then expect all heck to break loose in the bond market? No, not necessarily. No? Okay. You know, I think we've gone through a healing process. In other words, the market realizes that we don't necessarily need the Fed to handhold or to babysit us. So some of these tools, these measures that they've already employed, are beginning to fade off the books anyway. So it's really just down to the asset purchase programs. Is it important to you, there's this talk, the Fed kind of experimenting or looking into the idea of using reverse repos to mop up some of the excess liquidity that's especially going to be in the system a couple months, year or so from now? Yeah, you know, I mean, typically repo or reverse repo, they're part of the Fed's regular sort of regimen when they do open market operations. So obviously they're going to get a big workout this time around because it's really difficult to envision the Fed coming in and starting to sell the securities they bought. That would be too disruptive for the markets. So in the meantime, what they can do are these reverse RPs to sort of get us through the transition. Would it be a temporary or a permanent part of the overall exit strategy? Well, temporary, because as by definition, a repo has a term limit to it, and It reverses back. So it's just a temporary measure. In terms of the Treasury yield curve, do you expect to see lower rates for the time being? Although, look, I'm just looking at the 2-year. It just popped up to 1.04% with the selling today. What is your outlook for the yield curve as we come to the year end? I think it's going to continue to be on the steep side. Our concern are the vulnerabilities at the back end of the curve. Right. Not that we're going to have inflation right away, but expectations on the rise. And the Fed's not raising rates anytime soon. To me, that's the perfect recipe for a steep yield curve. But what about deflation? This is coming into the vernacular with this talk of slack in the economy. Yeah, you know, that's interesting. If you do get a sense here of a deflationary setting, then the curve would probably flatten, that the back end would actually outperform. But I think that's just a near-term development, that will go away, and as we move into the next year or so, that we'll start to see the inflation side of the equation. And then as we kind of sum up here, are you confident U.S. Treasuries will continue to be the place where investors seek their alternative, their secure place, their haven? Yeah, in terms of flight to quality, absolutely. You know, you see it as well with the dollar, how the dollar trades. So I think those are sort of the risk haven plays, as it were, and we can see just the opposite. When investors begin to move out on the risk curve, those will be the areas that underperform. And let me just get your take on what you're expecting to hear in terms of the Fed, how it will characterize the economy, and when will we see rate tightening? Probably not for a while. That seems to be the consensus. Right. I think based upon comments Bernanke has made, they'll probably acknowledge the recession is over. The recovery faces headwinds such as tight credit, tough labor market conditions, and that they'll probably say the Fed funds rate, or they'll keep rates low for an extended period of time. Kevin Flanagan, fixed income strategist, Morgan Stanley Smith Barney, setting us up for the Fed from the fixed income side of things today. Many thanks. Thank you.